Okay, hi there and welcome to another video on business objectives. We're going to focus for a few minutes on sales maximization and take you exactly through what you need to learn. So sales maximization is an alternative business objective to profit maximization. Here's our starting diagram. The output where marginal cost and revenue intersect is the profit maximizing output for a business. Sales maximization is an alternative objective. It involves actually selling a bigger output at a lower price and making less profit. So sales maximization happens when the unit cost, the average cost, intersects with the demand curve, the average revenue. So it's where AR meets AC, shown by the orange circle here. Let's draw in the output. That gives an output of Q1, and we can sell that output at P1. So sales maximization is an output where cost equals revenue. At this output, assuming we build normal profit into costs of businesses, at this level of output, normal profits are made, otherwise known as the break-even point for a business. This is sales maximization. So sales maximization is a theoretical objective of a business, which involves selling as many units of a good or service as possible, but without making a loss. We've shown it diagrammatically. Let's have a quick look using a table of data. Oftentimes you're given this kind of data in a multiple choice question. So here's a firm with output rising in units of one, revenues and costs as shown. Well, if we take total revenue minus total cost, we can fill in the final column to show the total profit. And the firm initially makes a loss because of the fixed costs, breaks even actually at output 1, but breaks even again at output 5. Well, the highest output consistent with avoiding a loss is output 5, where the unit cost and the unit revenue is both £30. So that is the sales maximization output. Okay? Why might a business choose a sales maximization objective? What are the motivations behind this as a possible business choice? Well, perhaps the business wants to achieve a fairly rapid, pacey growth of market share. Perhaps they want to stay in the market. They're an entrant in the market, and they're prepared to sacrifice some supernormal profit in the short term to increase their market share. Because increased market share then potentially builds up their monopoly or market power, and that might then enable a business to put up their prices and make more supernormal profit in the long run. A couple of examples. Well, here's an example you might want to think about. The rise of the deep discounters, the likes of Aldi and Lidl, who've both made pretty substantial gains in market share in the UK retail grocery sector, certainly over the last 5 or 6 years. This chart takes us from January 2015 to January 2020, right up to date. And you can see that Aldi's share of the market is now, 7% plus. It's overtaken the cooperative. Lidl has overtaken Waitrose. These deep discounters, these German retail firms, are quite aggressive in terms of opening new stores and maximising the growth of their business. And they're now in line to take on substantially the likes of Morrison's, Asda, Sainsbury's and Tesco. Another example in the financial markets could be a bank or a building society that decides we want to take a bigger slice of the market. Nationwide Building Society, many of you may have an account with the Nationwide. It's Britain's biggest building society, a mutual fund owned by savers. And as you can see, since 2011, in the aftermath of the global financial crisis, Nationwide's share of current accounts, the savings market, has increased quite sharply from just under 5% in 2011 to 8% in 2019. It looks like Nationwide has been pursuing a growth strategy designed to increase its position, its market share in the market for current accounts. So what does sales maximization involve? Well, typically it involves businesses aiming for growth. That normally requires them to charge lower prices for their goods and services, certainly lower prices compared with or contrasted with profit maximization. And you need to be able to show that clearly on a diagram in your exam. This, of course, has consequences for economic welfare, particularly consumer surplus. If businesses are aggressively cutting prices, then consumer surplus should increase, certainly in the short term, and lower prices might also increase the real incomes of consumers as a result. So think about some of the consequences of growth sales maximization for economic welfare. There we go, a quick flick through a revision session on sales maximization as a business objective. Thank you.